inventory. Question 1. Per International Accounting Standard 2, which of the following statements are not correct? The cost of goods produced by a manufacturing company will only include material and labor. This is wrong because it also will include production overheads, and we choose this answer. Inventory should be valued at the lower cost of and net realizable value. This is correct. FIFO is not acceptable method to value inventory. This is also wrong, and LIFO is not accepted method for evaluating inventory. This is also correct. So we choose answer C. So question number 2. Which of the following costs cannot be included when arriving at the cost of finished goods for a manufacturing company? General administrative overheads. This will not be included because these are administrative expenses. Depreciation of factory, plant, and machinery is included. Carriage in is also included. And carriage out is distribution expenses, so we choose answer C. Next question. Trigger Co. makes the following purchases in the year ending 31st of December. We see units, price per unit, and total price. At the year end, there are 500 units in an inventory. On closing inspection, however, 30 units have been damaged and are only worth $1 per unit. Trigger Co. bought these units as part of this delivery. Trigger Co. uses the FIFO system for valuing inventory. The figure for inventories for the end of the year would be. So let's proceed with Excel file. Here we can see units, price per unit, and total price. So we need to calculate the figure of the inventories on this data using FIFO system for valuing. This is our end number of units, and we know that at this date we destruct 30 units per $1. Let's amend the formula. So if we sum up these units, it will be 500, and sum of this unit will be 1100. So this is the answer using FIFO method. We choose answer A. Question 4. Josh Co. has already performed the area and inventory count. It has subsequently been discovered that inventory with a cost of 350 and a net realizable value of 200 has been omitted from the inventory count. What will be the effect on profit as a result of discovery? So inventory of a cost of 350 and net realizable value has been omitted from the inventory count. Here is our cost of sales formula, and if we see closing inventory reduces our cost of sales. So using the lower value of 200, our profit will be increased by 200. So we choose answer C. Next question. ABC Co. has performed an inventory count at year end and made the appropriate accounting entries for inventory. However, the accountant has since noticed a note on the stock sheet stating that an item valued at cost of 500 was damaged. The accountant knows that the item can now only be sold for 300 and needs to make an appropriate adjustment. Which two of the following entries should be made in the accounting records? We choose answer C in relating to statement of profit and loss, and answer D regarding statement of financial position, because the value of inventory has been reduced by 200. Next question. XYZ company has inventory at the end worth 40,000, and the accountant has just realized that one line of goods recorded at cost of 200 are only selling at 175 after the year end. Show whether this will cause the value of the following items in the financial statements to increase or decrease if correction is made. So as we found out previously, our profit will decrease, and so does the inventory. Next question. Charles has bought and sold the following inventory in March. Charles uses the FIFO method valuing inventory. What is the value of his closing inventory at 31st of March? So if we proceed to Excel file, we can see our data, and let's summarize our price for all units. And here we can use 250 units from the opening inventory for the price $2. And let's also use 100 units from this opening inventory. There would be 0, and here we got minus, and also we need to take 75 from these units. Here would be 0 and plus we use this price. So if we summarize our purchases, at the end we would have 625. Here would be our answer. Next question. Forgetful 4 has just discovered that its closing inventory has been understated by 25,500. What will be the effect of this error if it remains uncorrected? From previous questions, that if inventory is understated, then the current year profits will be also understated, and the next year profit will be overstated. So we choose answer C. Next question. DigitCo is a manufacturer with a year-end of 31st of December. On the 1st of January, it held inventory of 10,000 units, which were valued at $2 per each unit. During the year, there were the following inventory movements. DigitCo uses the periodic average cost method, FCO, for inventory valuation. What is the value of its closing inventory at the 31st of December? So let's proceed to Excel file. Here is our data, and we see the purchases with plus and sales with minus. So to find the average cost, we just need to summarize these figures for purchases and summarize units. So the average price for one unit would be this. Let's round it. And let's calculate the price for 6,000 units. It would be, so this would be our answer. As we can see, the closing inventory in September was calculated using continuous average cost method. So if we proceed to our data, we can see that from September, we used this method. That was our opening inventory. We can sum up these figures and sum up price. And let's calculate the average cost rounding this number. And here we also can see that there are sales of this amount of units. Here we multiply this amount by -1 because that were our sales. And if we summarize, we will have this amount. This would be our answer. Next question. A company values its inventory using the average cost method. It started trading on the 1st of January with no inventory. The following transactions have taken place. Here we can see purchase and sale transactions. What is the value of the closing inventory at 31st of December based on period and inventory records? So let's proceed with our data in Excel file. Here we can see our items and price per unit. So we need to calculate average cost September. Let's calculate the price of all units that were bought. And for August and sum up them. And let's also add units. Here we can get the price of 1 unit. And also as of September, let's calculate the amount of units. Would be 400, and let's calculate the sum. Here would be our sum, 84,900. So we choose answer A. Next question. A company values its inventory using the average cost method. On the 1st of January, it had opening inventory of 200 items, valued at a total of 40,000. The following transactions have taken place. What is the value of the closing inventory as at 31st December based on period and inventory records? So here is our data from this question, and let's calculate the whole amount of items and total amount of value for each items that were for opening and bought, and total amount of items. And let's calculate the average cost. Here would be our answer. Next question. A company values its inventory using the average cost method. It started trading on the 1st of January with no inventory. The following transactions took place in January. Here let's see the purchase and sale of inventory. And the question is, what is the value of closing stock on 31st of January using average cost on this continuous accounting records? So here we can see our data from this question, and we need to calculate real value and average unit price using continuous accounting records. So what would be the total value? Let's multiply price of 1 unit per unit. Here would be 400, and average unit price would be 20. And let's proceed till the 4th of January. And here you can see that we make purchase, and let's also calculate the sum, but also let's add this total value because we calculate via continuous accounting records. And total units for this purchase would be 25, and average price of 1 unit $23.2. And for January, let's calculate using this price as continuous. And if we sold, we'll extract this amount from this. And previously we had 25 minus 15, it will be 10. So average price would be the same. And for this purchase plus this price and price per unit, we had 10 units remaining at the 15th of January, and for 21st of January it would be 20. So we use 20 for formula. And our response would be this. Next question. A company values its inventory using the average cost method. On the 1st of January, it had opening inventory of 300 items, valued at a total cost of 60,000. The following transactions have taken place. We see the purchase, sale, again purchase, and again sale. The question is, what is the value of the closing inventory at the end of the year based on continuous inventory records? You should round the nearest whole figure in your calculation. So here is our data from the question. This is opening balance, total value cumulative, and average unit cost. So let's use continuous accounting records for calculation of closing inventory at the 31st of December based on continuous inventory records. So here we buy. So we need to multiply this by this and plus previous value. And we have 700 units. Let's round. And here we sell, so we need this. And we had 700 and we sold, we have 400. Let's also round. And here we purchase. And we had 400 and we bought 300, we have 700. And here we sold, so we need to subtract from this amount. We had 700 and we sold, so we have 500. So here would be our answer. So let's proceed with question number 15. Football Co. bought and sold the following inventory during May. Here we see opening inventory of 200 units, which had been bought at a price of 1.25. Football Co. uses FIFO method for valuing inventory. What is the value of closing inventory at 31st of May? Here we can see our data and formula for closing inventory accounting equation. So let's calculate it. We had opening inventory, this amount, plus purchases, and minus sales. Here would be our closing inventory. And the price for FIFO method when we purchased and had opening inventory of 200. It would be, and we have sale, so it would be this amount. And we also have remaining 250. And the price was per one unit was this. So here is our closing inventory evaluation. Next question. Rahima owns an art shop. She provides the following information regarding the inventory of the picture frames and the reporting date 31st of December. The value of inventory that should be reported in the statement of financial position should be answered here. So here is our data, and we need to take for calculation the lowest price. So here is 7. So we use 7. Here we see 11 and minus cost, it would be 10. And here cost per unit would be 20 is the lowest. And let's sum up the prices. So here would be our answer. Next question. Stade & Co has closing inventory of 200,000 at the reporting date of 31st of March. The following items have been included at cost. Here we can see 150 jackets, but let's calculate the lowest price and 175 trousers, which with cost each were sold in bulk to an overseas customer for 25 each. And selling costs amounted to 20% of the proceeds. So the question is, what should be the value of closing inventory in the statement of financial position at 31st of March according to International Accounting Standard 2? So we have jackets and we have trousers. We have also the discount for jackets. And let's calculate the price with discount 40%. So the price with discount would be 30, and without discount it's 25. So we do not change anything. And regarding trousers, we have $24 for each price, for each trousers price. And price with discounts. And our discount is 20%. So the difference of price would be 700. And so we should amend our closing inventory. So here would be our answer. Next question. Clara has made some errors when valuing her closing inventory, which is overstated by 10,000. The profit for the year reported in the financial statements before correction of this error was 80,000. What is the profit of the year to be reported once this error has been corrected? So we have closing inventory overstated by 10,000 and profit with errors of 80,000. So profit without errors would be this amount minus 10,000. As our closing inventory was overstated, we need to subtract 10,000. So thank you for your attention.